Welcome back to C. Myers Live. I'm Sean Zimmerman, Senior Vice President at C. Myers.
And I'm Charlene Leland. I'm a vice president at C. Myers.
And we're here today to talk about liquidity and the continuing importance of liquidity as a risk for financial institutions. It has been evolving somewhat, though I will say, we look to the first part of 2024, many financial institutions have seen deposits flowing back in to a certain degree. But I want to issue a word of caution to organizations that some of that may be seasonality. You may see deposit inflows come back in for the first part of the year. I'm not sure we're completely out of the woods of deposits being back to quote unquote normal. So it'll be really critical looking into the second half of the year to see how things progress from a liquidity standpoint as it relates to deposit growth or lack of deposit growth if that comes back. But I have seen, in terms of an evolution, another area that organizations have adapted to is how they're pricing their products, in particular loan products, and what they're doing on the deposit side to manage their margin more so. When liquidity risks came kind of, I will say out of nowhere, not really, but some people, it felt like that to some
Felt like it,
organizations.
yeah.
There was a rush to kind of get back in front of liquidity, and some organizations didn't do a great job managing their pricing. But we've seen with the many financial institutions that we deal with, they're doing a much better job in terms of pricing their loans effectively relative to their ever increasing cost of funds.
Okay, so Sean, we're in this slightly different phase of liquidity management than for the industry, and I see the same thing. It felt a little, almost a little panicky when things first started to shift because it shifted pretty quickly and in a big way. So now it's people are a little more comfortable in the ongoing. So as you are a former CFO, a former CEO. What would you say now? What places should be focused on as they go forward in this liquidity journey that we've all been on?
I think a critical aspect of that is understanding your liquidity position at a much deeper level. You need to know more than just what's my current liquidity position. You need to have a fairly comprehensive understanding of a liquidity position, looking out at least 1 year. And I say that not just based on my experience, but also directly from conversations with regulators, key people that are out examining financial institutions all the time. And one of the things that they have been hyper focused on ever since some of the major bank failures early in 2023 is liquidity. And I can tell you from them, we're hearing that directly, that they want to have financial institutions demonstrate that they have an understanding of their liquidity position, and that understanding needs to go out at least 1 year to understand what their liquidity position looks like throughout that time frame.
So Sean, you're differentiating then between the shorter term operational liquidity that goes out? Often organizations have that for a month or so, and it's quite detailed. And you're saying in addition to that, because of course you need to understand what's going to happen tomorrow, but you're saying need to definitely look out at least a year. So can you talk a little bit about what that would look like?
Yeah, it's a really important part of this. So as you suggest, many organizations have a very detailed understanding, whether it's 30 days or 90 days out of their liquidity position. But as you're looking out further, you have to have an understanding of what some of the key assumptions are that lead into what your liquidity position will look like. And so a lot of that goes back to some of the things we were talking about before. What will your deposit inflows look like? What are your funding sources going out? What does your loan growth look like? And there are a lot of assumptions that go into that. And we encourage organizations not just to make their assumptions about what that will look like going into a year, but then also stress test those assumptions. Right? What if you're wrong? If things go differently than you assumed, like think about budgets. Most every organization does budgets. How often are your budgets exactly right? So that the same kind of dynamic plays out when you're looking at your liquidity position and looking at a year. You're not going to be exactly right on what it is. You're going to have some assumptions built into that about what your loan growth is. But what if that turns out differently? What if loan growth accelerates much more quickly than you thought? And what if deposit growth that you had planned for didn't happen quite as you thought it might? That could put a big stress on your liquidity position. And if that happened, what would you do?
Yeah, I think that's the question, right? What would you do? And I think the mind goes for many goes straight to borrowing, but there are a lot of different alternatives. So could you maybe talk a little bit about both borrowings because that's really important. That's a really important source of liquidity, but then some of the other things that you could do if in a tighter liquidity position, like you say, if it doesn't go the way you thought, maybe you were set up just perfectly for the planned loan growth, deposit growth, all that, and if it doesn't, then what?
Right. There are a lot of potential levers that financial institutions can utilize if these assumptions fall out in a way which tightens your liquidity position. So you mentioned one, the borrowing lines. I think that's a really important one. I highly encourage all financial institutions not just to have borrowing lines in place, but to have significantly more borrowing lines in place than they think they'll need. And so part of the reason that I say that is that lenders can sometimes scale back the lines that they have advanced. So they perhaps gave your organization a line of credit borrowing line of $100 million. They may scale that back. You may not get access to that full line. So that's part of the reason I say have significantly more than you think you'll need. But that's just one of the levers, right? There are a lot of potential levers, and I encourage organizations to really think them through. What order might you take these actions? Things like slowing your loan growth. So obviously, if loan growth is taking off and deposit growth is not funding that enough, one option you could do is slow loan growth. But are you comfortable with that? Right? If your customers want loans, are you comfortable scaling back the amount of loans that you might be willing to provide them? But part of that dynamic also factors in what's the marginal cost of funds that you need to get those loans. So now if your funding sources that you had previously anticipated aren't coming through and you have to look at borrowings or other more expensive potentially funding sources, will you still be able to net the amount of margin that you feel you need for that type of loan? So that may factor into your decisions on slowing loan growth. But there are a lot of other alternatives too. Raising your CD rates, right? You could raise CD rates to try to generate interest and bring funds in. That can have other potential impacts as well in terms of changing the mix of your deposits if some of your other customers see those rates and then move their funds over there. So maybe you're more comfortable with brokered deposits. That's certainly a viable alternative. You could also sell investments. We've seen some clients turn towards selling, in particular, shorter duration investments where the losses were less in today's environment as a potential. But whatever sources and levers you're considering, particularly when we're talking about broker deposits and borrowings, make sure you understand them and have tested them out, or at least understand the process. How long does it take to get the funding that you need? Do you know all of the steps? Have you gone through them before to make sure that it works as intended? Because I know that there were some of the instances that happened with bank failures where they didn't have that level of knowledge or understanding of how long it will take, and that ended up being a significant issue for them. So one other thing I want to add as it relates to the borrowing lines, when you're looking at borrowing lines, talk to some financial institutions that are looking at things like the discount window or the central liquidity fund as a pillar in their funding sources. And that is really only a source for short-term funding needs. So just make sure that people understand that and wouldn't make that your go-to as your borrowing lines that you are intending to utilize for longer-term funding sources. And I know going back to conversations earlier about regulators, they view that very similarly. They want to make sure that people understand those are short-term sources, not long-term sources. So if you have borrowing lines, get some borrowing lines that allow you to borrow for longer terms.
That's great. And I can't, the idea here, the theme I'm hearing over and over is no surprises when it comes to liquidity. We don't want any surprises. Things can happen very fast, very quickly. It can change. So, to recap some of what you said today, you gave us a lot of good information. Um, but I'd say, number one, it's that get that deeper understanding of your liquidity position longer term. It has to go out at least a year. Make sure that you stress test the assumptions. Things will not go the way that we planned, just like as you said, for every budget ever made. And so stress testing, what are some things that could happen? And then understanding and prioritizing, well, what could I do? What levers could I pull? What are some alternative liquidity sources, and ensuring that those are solidly in place through testing and understanding the process and the timing. Anything you would add to that wrap up, Sean?
I think on the levers you might pull, I would make sure you prioritize those in your liquidity management process to understand these are the ones we think we'd be more comfortable pulling first versus other alternatives. And then on the stress testing, I would say at a minimum you have a base forecast that goes out a year. You have at least one stress test, and then how do you solve for that stress scenario? So that's your absolute minimum when you're looking at 1 year to have that. Certainly, you could do multiple stress tests of different types, but from an absolute minimum, I would suggest that.
Okay, that's great. Thanks for all the great information. As always, if any of you have questions, get in touch with us. We're here to help. And thanks for joining us for C. Myers Live today.
Thank you.
Bye-bye.